This video tutorial is designed to assist with the understanding of the content related to the unit CPPREP4125, Transact in Trust Accounts. Trust money does not belong to the agent. It belongs to one of the parties involved in the transaction facilitated by the agent. The agent is entrusted to hold those funds for a period of time until the transaction is completed. In New South Wales, the legislation relating a trust account is contained in the Property and Stock Agents Act 2002, which is Part 7 Trust Accounts and also Part 8 Records, as well as the Property and Stock Agents Regulation 2014, Part 4 Trust Money, Part 5 Records, as well as Schedule 15 Penalty Notice Offences. As part of your preparation for this unit, you should print a copy of the Act and Regulations and familiarise yourself with these parts of the legislation which specifically deal with legislative requirements for trust accounts. There are two types of bank accounts that are used by an agency. The first is the general trust account, which is used when receiving or paying money on behalf of a client. This account will have money such as deposit for purchase of property going into it, tenant rent, tenant rental bond, vendor paid advertising if the marketing expenses are paid in advance and have not yet been spent, and also money such as commission for the sale of a property, which will stay in the trust account until there is authorization from the client or their legal representative to allow the agency to disperse that commission into the second type of bank account, which is the general account, which is agency money and is used for the operation of the business and the agency's day-to-day expenses such as wages, insurance, electricity, office rent, etc. Some key points to remember about trust accounting are that all money collected on behalf of a client needs to be paid into the agency's general trust account. So money received by a real estate agent with a written direction for its use, such as advertising or marketing by the agent or money for another person, or a licensee who collects money must deposit the funds into the licensee's trust account before the money can be paid to the owner, showing a clear paper trail of where the money goes in and out. You must also issue a trust account receipt at the time of receiving the money. So if you receive rent payment in cash, then you would need to issue a trust account receipt right then and there to show that the money has been received. If the money was put into the trust account by way of EFT or a direct transfer, then a receipt needs to be issued at the time that the licensee becomes aware of the money in the trust account. It is forbidden to use trust money for personal use. So as an example, a tenant comes in to pay a rent of $500 at 3 p.m. on a Friday afternoon. The agent cannot use that money to go and buy groceries and then transfer the money from their bank account to the trust account. That would show a different paper trail and it would be a forbidden use of trust money. You need to forward all funds held to client, which is usually completed at the end of the month or also at the end of a transaction such as a settlement of a property sale. And finally, you need to maintain records of information that's been created, amended or deleted to show a clear paper trail, especially important when it comes to auditing. Essentially, there are two types of trust account. The general trust account, which we have mentioned previously, and this is the main type of trust account that is operated in real estate agencies. Only one account is required and must have a unique identifying number which is obtained from the New South Wales Office of Fair Trading at the time of opening the account. The account is then used for all clients and customers that have paid money to the agency in the course of real estate activity. A separate trust account can be opened with a unique identifying number to separate the trust money into departments such as property management and property sales, but it is not a legal requirement. This does, however, allow to easily distinguish between money that has been paid for property sales in comparison to property management. Another thing to remember is that the general trust account does not earn interest for the consumer. So the money that sits in the trust account does accrue interest, however, but it is paid to the Property Services Statutory Interest Account, and this money is then used by the Property Services Compensation Fund to assist people who are out of pocket because an agent or a conveyancer has failed to account for money or other valuable property that they have meant to be holding in trust on their behalf. The other type of trust account is called an interest-bearing trust account. It does go by various names, including special trust account, a real estate investment trust account, or interest-bearing deposit account. It is a joint account set up between two parties, such as the buyer and the seller, and the sale deposit of usually 10% is invested for a short term at a high interest rate. The account terms are generally 42 days, the time between exchange and settlement, or it can be longer depending on the settlement period. The interest is then generally split 50-50 on settlement between the two parties, although there can be variances such as 100% to the vendor, or there might be an 80-20 split depending on how it has been arranged and set up in the terms and conditions. We will now take a closer look at looking at the processes involved in receiving trust money. So the first obvious step is that the money comes in. The money can come in by way of cash, EFT, direct transfers, checks. All of those are valid ways that someone can pay money to the agency, and from there our process begins. The next step is to issue a trust receipt to the client or customer that has paid the money to the agency. So we will look at this process now. Trust account receipts must contain certain information which is outlined in the Property and Stocks Agents Regulation 2014. So some of that information that's required is having the name of the licensee. So you can see that information is provided, and the fact that it's a trust account receipt. So you can see that information. Next, you need to make sure that the receipts are consecutively numbered, so you can't skip pages, you can't skip receipt numbers. It has to be the next consecutive receipt number from the previous transaction. And then you would put in the date that the money was received. Received from, you need to put in the information about who's actually paid the money. So if this was a tenant, you would put the tenant's name. On behalf of, who it was. So if that was a landlord that it was on behalf of that you took the money, then you would put their name in there. And also you need to have their identified ledger number. So that might be their client initials and house number that they live at. You also have to put the description of what it was for. So if that was going to be, an advertising payment, and the property address. So you need to be able to determine what the purpose of the money was for. How you've received the money, so whether cash, EFTPOS, check, money order, direct transfer, how was it received? How much was received for that transaction? who actually receipted it, so the name of the person issuing the receipt and their signature of the person. And they don't have to be anyone that holds a real estate agent qualification or be as an assistant agent. This can be anyone in the office issuing the receipt, and they would sign off having received that money. Once the money has been received and banked, we then need to record it in the trust receipts cash book or transactions from all properties in numerical order for the month of operation. Each receipt that you have completed needs to be entered into the receipts cash book in numerical order. So we'll have a look at this now. So the information that must be contained in a receipts cash book is the date that the money was received. So when did we actually get the money paid to us? And also the date that we issued the receipt. We need to put in the name of who paid it. So in our case, we've got W. Lewis, and we're using an identification code of Lewis 1L, and that'll be up to the agency to create these identification codes, which will be used throughout the cash books computer systems for that particular client to identify them. And we're going to put in the description of the matter. So what was the payment for? So in this case, we've got VPA advertising, so vendor paid advertising for an amount of $1,089. Receipt number we used was 10, and we banked it on the same day. So we would do that for every single transaction that we receive for that month. And then at the end of that month, we would calculate the total that we have received. The next step is to record in each individual trust ledger. The next step, after entering the receipt into the trust account receipts cash book, you then have to update the individual ledger that has been affected by the transaction. So if we imagine that we're looking at the account of W. Lewis, ledger reference of Lewis 1L, and then we look at the sale of 8 Origin Street, Brisbane. So that is the account of this particular client. And we can see that the opening balance was 0. We started at nil. And then all of these transactions have transpired over the course of this month for this particular client. So on the 1st of the 9th, there was W. Lewis we received an amount on a receipt number 10 of $1,089. Then on the 4th of the 9th, for ABC Signs, we had to pay out via check number 10 an amount of $330 on that client's behalf, and then we have a progressive balance left of $759. Following that, we also paid on the same date Photos Are Us by check number 11, the amount of $220, leaving a balance of $539. And then on the 4th of the 9th, we also paid for realestate.com.au advertising with check number 12 for $539, and so then we had a balance of 0. Then after the marketing, on the 20th of the 9th, we received a buyer deposit from D. Lockyer for the amount of $25,000. So then the account is once again in credit for $25,000. And on the 30th of the 9th, obviously settlement has occurred, and we are going to transfer the balance of the deposit, which was paid out of the trust account via check number 18, amount of $1,487.50, leaving a balance of $23,512.50, which was then dispersed on the 30th as well as the commission for the agency, which was paid by way of transfer of that $23,512.50, leaving that client's ledger at a 0 balance at the end of the month. Now that we have looked at the processes involved when we are receiving money into the trust account, we are going to look at what happens in the processes for dispersing or paying money out of the trust account. So when money is due to be paid out of the trust account, it is very important that this withdrawal from the trust account can only happen after a transaction is completed. So even if you know settlement is going to be happening afternoon at 2 p.m, you cannot complete the withdrawal from the trust account until settlement has been effected and authorization has been provided. Speaking of authorization, it says with client's authorization. Now, authorizations can come via various forms. Authorization might be to pay for a repair or maintenance item, and these would be authority. So agency authority may have the authorization, or if there are amounts over and above, you would have to have a letter in writing from the clients. More information about this is contained in the learner guide for this module. It's the licensee or authorized person. So there can be someone else who is delegated the responsibility, and generally they will have to have it written into their employment agreement and also have the appropriate qualifications and license categories to be able to do this. The next step is to issue the trust check or transfer the money directly from the trust account to the client's nominated bank account. These are the only two authorized ways that you can pay money out of the trust account. You cannot issue cash out of the trust account. So all payments for customers, clients, and suppliers are made by way of check or a bank transfer. Now that we're making payments out of the trust account, we also have to record these payments in the trust payments cash book. So each amount that's been paid out of the trust account is entered in order into the payments cash book for the month that it was paid out. So once again, if I just go through the details, you can see that the information we have is the date that the payment was made, followed by how much it was that we paid out for $330 with a check number 10, and we made the payment to AB Signs on behalf of W. Lewis, which is the ledger that we've identified at the end, and the description for the amount that we paid out is a for sale signboard. So you can see that each of these is in order and how much and the check numbers, so that we have a paper trail that's going to correspond with all of these amounts that have been paid out of the trust account. These payment transactions that are being dispersed from the trust account are going to be recorded in the trust ledger for each client. Let's now look at why we need to do a bank reconciliation.
Why do a bank reconciliation? Managing properties is a pretty hard job, especially keeping track of all of that money. How do you know if all of that money is where it should be? You're not an accountant. A simple daily bank reconciliation is the answer. A bank reconciliation is making sure all of the receipts and payments in your agency's bank account are exactly the same as the receipts and payments in your property management software. In most regions, it is mandatory that a bank rec is conducted every month to make sure that all of your owner, tenant, creditor and agent funds are correctly accounted for. But seriously, who can remember everything that happened a whole month ago? Reconciling Daily helps you to find any misplaced money and rectify those errors ASAP. Remember, you are dealing with other people's money, so if you have made a mistake with other people's money, then those other people will be really angry with you. A successful daily bank rec equals very happy clients and a happy you.
In simple terms, a bank reconciliation ensures that the amounts showing in the trust bank account and the amounts in the trust account cash books are the same. In the legislation, bank reconciliations are covered under the Property and Stock Agents Regulation 2014, Clause 26, Records of Trust Account Transactions, which states under 6, the licensee must, at the end of each named month, prepare a statement reconciling the balance of the licensee's trust account with the balance of the related cash book or other record. The bank reconciliation needs to be performed after the month has ended, for example, the first day of the following month, to ensure that all of the transactions have been completed and no late transactions come in after the reconciliation for that month has been completed. If there is a difference between amounts showing in the trust bank account and those showing in trust cash books, and accounts cannot reconcile, this is the result of a discrepancy and must be identified and remedied as soon as possible. The licensee must keep certain records, and the records that must be kept by a licensee is covered under the Property and Stock Agents Act 2002, Part 7, Trust Accounts, Division 1, Keeping and Inspection of Records, Section 103, Licensee Records, and Section 104, Licensee to make and keep certain records. When looking at this particular section, you will see that the records that need to be kept include all source documents. So this includes your invoices, receipts, check butts, bank statements. A source document is anything that shows the original transaction. Your trust journals and cash books, so your payments cash books, your receipts cash books, your transfer journals. Trust checkbook, as well as the trust deposit book. Trust ledgers for each of your clients and their properties. Trust trial balances, and trust bank reconciliations. And all of these records need to be kept for at least 3 years after they are made, although many agencies will hold on to these under the ATO requirements, Australian Taxation Office, of 5 years. Let's look at performing a bank reconciliation. The first thing we need to look at is what is our opening bank balance. So have a look at the bank statement to see what is the amount that we are actually opening the bank balance with, and enter that in to your opening bank balance area. So in our example, we're going to use $10,000. The next thing that we need to look at is how much money have we received into the trust account for the month. We're going to assume that's another $10,000 that we're going to have received by way of rental payments, deposits for purchase of property, etc., which gives us the subtotal of our opening bank balance plus our receipts journal total of $20,000. We then need to have a look at how much money have we actually paid out of the trust account. So we will enter in our check numbers and the corresponding amounts. So I'm going to just use basic numbering of 1 through to 5 for the checks. And I'm going to say check 1 was for $5,000. Check 2 was for $1,000. Check 3 was $500. Check 4 for $200. 5 for $1,000, which gives us a total of presented checks of $7,700 for this month. If there was an amount that we had put a check forward and it had not yet been presented, that's where we would have it, another area of unpresented checks, so that we can ensure that we've accounted for that. And finally, we're going to tally our total of our incomings and take away our outgoings to give us a figure of a closing balance, which is shown in our cash books as $12,300. So that is the figure that we should see on our trust account bank statement. So we would have a look at our trust account bank statement and compare the two balance amounts to see, are they identical. If they're not identical, we would need to go through each of the transactions to find out where it is that we've gone wrong or what the amounts are that are not marrying up to work out where the discrepancy lies and correct it. Let's now look at the trust account trial balance, which is covered under the Property and Stock Agents Regulation 2014, Clause 29, Trust Account Ledger Trial Balance. The clause states that a licensee must, within 21 days after the end of each named month, prepare a trial balance statement of all ledger accounts current as at the end of the month. So that means any accounts that continue to be active and have money in them must be listed in the trial balance. And there's some information that the legislation outlines in terms of what the trial balance must contain. So we have to specify the month to which it refers and the date. So for the purpose of the exercise, when this is actually completed, there will be a date stamp of completion. So we will take that as the date, but generally you would have another area where the date that the trial balance is completed would be entered. And list each account that does not have a zero balance at the end of the month, stating the person to whom the agent, the reference number, identification number, and the balance of the account. We have to show the total of the ledger account balances at the end of that month and show a comparison between the total and the balance in the cash book that was reconciled with the balance as previous Clause 26, which was the bank reconciliation that we performed. So basically, if we look at this template, firstly, we would enter in our amount that we had reconciled from our bank reconciliation, which was our $12,300. And of course, the total for that debit column was also going to be $12,300. Over to the credit side, our opening balance for the month was zero, and then we have our Ted Johnson TJ02 as required by the legislation. That is the only active ledger for the month with an amount of $12,300 remaining. So we list that down and then we tally the totals being $12,300. Our total amount again being $12,300, which as you can see when we compare the debit and credit amounts, they are balanced. The bank account says one thing and the computer software or cash books say another, or money should be in the trust account to make a payment and it's not there. This means there is a discrepancy or deficiency in the trust account. This could occur for a number of reasons, being potentially an overdrawn account, or there could be a data entry error. It could be that the account has been compromised. Perhaps there's been a dishonest check or unclaimed money. More information on this topic is provided in the learner guide for the unit of competency for you to read. However, if it is the case that we have an issue to do with an overdrawn account, under Section 89 of the Property and Stock Agents Act 2002, it's a requirement that the licensee must notify the Office of Fair Trading within 5 days of the account being overdrawn. Failing to do so can lead to disciplinary action. And if the agency does not report this, it will get discovered at the next audit. Financial institutions also have an obligation to report overdrawn accounts, and also the Office of Fair Trading have the right to random audits. So there's no getting around this fact. If an account becomes overdrawn, you must notify the Office of Fair Trading and explain why and how it will be remedied. The trust account must be audited to make sure that the licensee is using the trust account as it should be used. Audit requirements are specified under the Property and Stock Agents Act 2002 under Part 8 Records, Division 2, Audit of Licensees' Records. The audit period for each year is 12 months and it runs from the beginning to the end of each financial year. If it is the case that you are not using a trust account as part of your day-to-day activity in real estate, you don't need to have a trust account. So some agencies may only perform minimal transactions and they might use a solicitor's trust account. So if they're not using a trust account in their own name, then you would need to submit a statutory declaration. You do have to use a registered auditor according to the Act. So it can't be Uncle Bob that has done his accounting degree. It must be approved auditor by the Office of Fair Trading according to the legislation. The reports need to be lodged with the New South Wales Office of Fair Trading, and that has to be done by the end of September. So the 30th of September each year, those have to be lodged, and there are fines for breach of audits. The Office of Fair Trading can also conduct random audits at their request. So that's covered under the legislation as well. A licensee cannot deny a random audit. To make the trust accounting process easier and more efficient, most agencies will use some sort of computer systems for their trust accounting. You do need to ensure, however, before purchasing one that it has the capacity to comply with the law. Also, using computer systems means that you have to comply with a section of legislation under the regulation clause 22, which specifies that if documentation is to be stored in electronic form on a computer, then the licensee must maintain those records and have sufficient capacity and backup capability. So if you choose to store this information on external hard drive, it has to be large enough to hold the backup data. Also have to ensure that the information is backed up monthly. So the legislation says monthly, but if you've got large volumes of transactions occurring on a daily basis, backing up monthly is not going to be regularly enough, and if you needed to call on that backup because you've lost data, you will probably have had way too many transactions to try and find if it hasn't been backed up. So most agencies, particularly if they've had some sort of issue with losing data in the past, will probably back up many times a day, but at least once a day would be highly recommended to ensure that the backups are done sufficiently enough. You also have to ensure that you don't have the backup on site, so that if there was a fire or if there was some sort of event that occurred, that backup is still going to be secure. So a lot of the time, agencies will use cloud solutions. So if we're going to store the information in a format that it is going to be backed up in the cloud, again, you can't do that any less often than monthly, but a lot of those systems have automatic functions where it backs up once you've made a change in the system, etc. And finally, you have to also ensure that it's unaffected by storage events. So what does that mean? There was a case where a property manager was responsible for taking the hard drive home at the end of the day to ensure it was off-site, and upon needing the information, it was found that the drive had been wiped clean. From their investigations, they found that the property manager was storing this hard drive on top of a fridge, which had caused magnetic interference and causing the drive to be wiped clean. So needing to ensure that if we're storing these backups, that they're going to be unaffected by these types of storage events. The final topic for trust accounting that we're going to look at is unclaimed money. So sometimes clients don't receive money owed to them, and that could be for reasons such as they've moved address, or perhaps they've changed their name, or they've lost paperwork, or they've forgotten about the fact that they've had a cheque that they were supposed to bank. So in New South Wales, in January of each year, if a real estate agency has unclaimed trust money sitting in their account, there is responsibility that if it's been there for 2 or more years, as at the 31st of December, which is set out under section 62(1) of the Conveyancers Licensing Act, they have to report this information to the Office of Fair Trading. I'm not going to go into depth in this particular topic because more information can be obtained on the process by going to the website listed, and it is also provided in your student learner guide for you to be able to read more about. But just to give you an example, you might have a situation where you have issued a cheque for the balance of a deposit to a client, and you find that it hasn't been banked, and you contact the client and they say, oh look, I've lost the check, you cancel out the check, issue another check, and once again it hasn't been banked, you contact them and this time the number's disconnected, the checks come back saying return to sender, and so you've got no means of getting this money to the client. So you then have to hold on to this money in your trust account for the period of at least 2 years, as at the 31st of December each year. And then if the client does not come forward to claim the money, you would then have to forward that to New South Wales Government Revenue, and it will be held there until such time as the client comes forward to claim it. So you can do some research on the New South Wales Government Revenue website to look at how you would lodge the claim, to search for any unclaimed money. This brings us to the end of the video tutorial for CPPREP4125 Transact in Trust Accounts. Hopefully you have acquired knowledge to assist you with completing the assessment tasks and answering the assessment questions or written questions. Please ensure you have read the complete learner guide associated with this topic in addition to this video, as there is a lot more information contained in the learner guide on this topic.